Hi, in this video of the series Government Intervention, we're going to be looking at a sales tax as a policy, and in this particular case, a sales tax paid by consumers. When a sales tax is paid by the consumer, what happens is an effect on the demand. In effect, whether the tax is a certain number of units of money or whether the tax is a percentage of the price charged, the impact will be to observe a decline in the demand or equivalent to a decline in demand. And so the way we would register the tax paid by the consumers, the sales tax paid by the consumer, would be with a retraction of demand. So demand would essentially be net value per unit less, since each unit is valued at whatever the price of the unit is plus the tax. So that would be the impact on demand. As you can see, that would create a decline in quantity as well as in the price per unit that the producer gets for the good in question. That would also create a deadweight loss equivalent to this triangular red zone in monetary unit value. So you should see less consumer surplus, less producer surplus, a deadweight loss, and you would also see an amount of revenue called sales tax revenue going to the government, and that amount would equal the amount that I just drew in purple here. So that purple amount of money would be the sales tax revenue. The red square would be the deadweight loss. The consumer surplus, I'm going to highlight in yellow. So that yellow triangle would be smaller than the initial amount of consumer surplus. And the producer surplus I will highlight in blue. So when should you implement a sales tax? Whenever such a tax yields an amount of revenue that is superior to the loss of value by consumers and producers, inclusive of the deadweight loss. Why would you want this to happen to the market? Again, most policies of intervention in a market are not things you can just ceteris paribus, that you cannot just look at in all things being the same. That sales revenue might be needed for institutions that support the market environment and that are not priced into the market environment. For example, when you go to a store to buy something, you have to drive there and you have to go into the store and pick it up. And if you drive on roads that are unsafe, you might damage your vehicle or you might get hurt. And so maintaining roads is not something that we sometimes see as an important feature of the market supply and demand. But in effect, one of the main sources of value from markets is not visibly captured in surplus terms by the market. And it is all the different things that we take almost for granted sometimes. And it's in the realm of public goods, which is why we're going to be talking about public goods at the end of the semester so that we can understand why it is that that becomes an important feature of our cost-benefit analysis. You might say, well, why not build private roads? Well, because private roads may not be as effective as public roads, in that you would have areas that would have super nicely smooth paved streets where affluent people live, and then you might not have roads at all where unaffluent people live. And if that's the case, and you have to go through a non-affluent area to go between you and the location of goods and services that you are wishing to provide, you're going to have to bear the costs of passing through these areas. And that cost is not captured in the deadweight loss or anywhere else in these graphs. So that's the importance of the particular intervention policy that we call sales tax. Now, if the sales tax is a percentage of the price of the good, then what happens is that commensurately with the price of the good rising, the impact of the tax is more and more severe. That makes the sensitivity of consumers to the sales tax be more and more dramatic as prices go higher and higher, in which case the distribution of consumer surplus, producer surplus, and sales tax becomes more problematic. And it is a feature of what we would call percentage sales taxes, as opposed to the first case, the parallel decline in demand, which was what we call an ad valorem based on value tax reduction, which is the same amount of money no matter what the price of the good is. So the second drawing here would actually have a very different profile of consumer surplus and producer surplus, because the equilibrium would be influenced by this more dramatic impact on these particular higher prices. And so we would see a much more drastic effect on the amount of the good and the price of the good in equilibrium. We would see a much harsher impact on producer surplus, which I'm now drawing in yellow, consumer surplus, which I'm now drawing in pink, and the tax revenue, which I'm going to draw in green, would be this rectangular portion here. And we would have a deadweight loss as well, which would be this red triangle here. I hope that this graph was useful in looking at the issues surrounding the welfare. By welfare, I mean consumer surplus, producer surplus, total surplus, and deadweight loss, that this particular policy and that all government interventions tend to redistribute in a marketplace with the ultimate intent of trying to recover some indirect cost to the provision of the goods in this market, or some unmeasured social value that is, from a normative welfare point of view, not from a positive point of view, from a normative point of view, desirable by people who partake of the market activity. In addition to this effect on the welfare consequences of the government intervention, we also have another issue with these types of tax policies, and it's called the issue of incidence. Incidence refers to who pays the tax, as in who bears the burden for the tax. For example, just to give you more clarity, if you're a renter, you don't pay property taxes to the county where you live in. Only owners of property do that. So if you're renting an apartment, the landlord has an obligation to pay something called property taxes. Now, the landlord doesn't live in your apartment complex or in your apartment unit necessarily. So it must be the case that if the landlord doesn't really derive the benefits of using the place and has a tax to pay on the square footage or on some feature of the rental unit in question associated with perhaps the something called the assessed value of such a unit, what the landlord's going to do is pass that tax burden onto the renters. And therefore, part of what you pay in rent is in effect something that'll ultimately go to cover or help cover the landlord's property tax liability. And so the issue of incidence has to do with not who delivers the check to the taxing authority directly, but who ultimately, where did that money come from that paid that tax? And that's what we mean by tax incidence. So it's a different phenomenon than consumer surplus and producer surplus. And it has to do with the relative slopes of the supply and demand curve, with the relative elasticities of demand and of supply. And the rule about incidence is that the higher the price elasticity of demand in relation to the price elasticity of supply, the more of the tax burden carried by the supply side of the market. So those who are the most sensitive to price changes in a market are the ones who least carry the burden of an impact on the pricing effects of a policy, such as a tax policy. So if you're in a particular market where people are paying a sales tax, consumers pay a sales tax on a cigarette packet, for example. Well, cigarette is a highly inelastic commodity because people tend to get addicted to cigarettes. They tend to buy cigarettes no matter what the price really is. So if you impose a really high sales tax on cigarettes paid by the consumer, the burden of that tax will be borne by the consumer, by the people on the demand side, because they're the ones who have price inelasticity. Let's take some other commodity. For example, soda. Most people like to drink soda, but not everybody drinks soda. And in fact, a lot of people are very health conscious and realizing that they don't want to drink soda because it's not good for your health. It has other impacts not measured within the market confines of supply and demand. And if you impose a really high tax on a sales tax, a very large sales tax on soda, and consumers don't feel strongly about soda drinking, they will substitute away from soda rather easily and not pay the tax necessarily. So in that situation, the tax burden will be relatively carried more by the suppliers of soft drinks, and they will absorb the cost within their profit margins. So maybe instead of making 300 or 400% on a cup of soda at a movie theater or at a 7-Eleven or at some local store or at some local restaurant, they might make a lesser percentage, and they will take the sales tax and effectively pay it out of their profit margins. And consumers will probably then see not a complete rise in the overall price they pay for the good, and suppliers will be bearing the tax. So in that situation, a sales tax on consumers in the soda pop industry would actually find incidence in the supply side because the supply side is more elastic than the demand side. But in cigarettes, you would probably see a sales tax borne by consumers rather than producers. I hope the issue of incidence has been clarified by this short video, and more to come.